Oh, oh, says live video starting. Says you are now live.
All right, there we go.
Do you see me on?
Yep, I've got it up there. You're officially live now.
Excellent. Now, for some reason, I still don't see it. But maybe that's because I'm me and Facebook knows that I'm me and it's not going to show me to myself.
Maybe, but I'm looking at it now and it's live on my phone, so as soon as we got the technical issue sorted out.
Well, yeah, there we go. And the preview, though, is like just the center of our two screens. I guess people looking at this on a cell phone are going to be. Can you see it on your cell phone?
Yep.
Like, can you actually connect to the stream and see what you're seeing?
Yep.
And how does that look?
Yeah, it's working just fine.
Okay, good. So, hi, I'm Byron Armstrong at Remax Kelowna. This is Graham Campbell from Homeline Mortgages, Dominion Lending Centers, and this is my first ever live stream interview video thing. I'm sure there's going to be lots of technical difficulties and hiccups. It's taken us 20 minutes just to figure out how to get online. So, if you are joining us, thank you, and we appreciate your patience. Graham, would you like to introduce yourself?
Yeah, thanks so much for having me on, Byron. So as I said, I'm a mortgage broker with Homeline Mortgages. So I've got a small team here in Kelowna, and we've been doing business for just a bit over 4 years now. So we've been steadily growing and definitely had some good growth over the last couple of years. We're now top 5% of DLC agents in Canada. So we've got a pretty good amount of volume and experience on our hands that we've developed over a relatively short period of time. And I met the lovely Byron, and we connected and we were chatting about rates and the market and kind of what's going on in that world. And that's how we came about to do this live stream.
So what is going on in that world? Of course, everyone knows that the bank. Well, maybe everyone doesn't know. The Bank of Canada has hiked rates a number of times this year. So, how much have rates been increased since January 1st?
Yeah, so in this year so far, we've had 2.25% increase to the prime rate. And so the prime rate is what variable and adjustable rate mortgages are based off of. So if you have a mortgage with a variable or adjustable rate, your amount of principal and interest could change, or your payment could change, or has changed rather. So it's quite a substantial increase. Everything that we were kind of talking about for the last year or two, we were expecting a much slower increase by the Bank of Canada. A number of senior economists and other financial analysts, kind of said, we're going to see, maybe 1.5% increase in 2022, and now that's being drastically blown out of the water. Just halfway through the year, we're already over 2%.
2.25%, yeah.
So, pretty significant jumps there on the rates, and we are still expecting more rate increases to come. So, there's still more rate hikes coming in the future. Fixed rates have jumped up a fair bit, and now some lenders have actually started to decrease their fixed rates. Not many and no major bank lenders have decreased the fixed rates yet. The fixed rates, unlike the variables, which are based on that Bank of Canada prime, they're instead based more off the 5-year bond yields.
So you're saying that they're going to decrease the fixed rates?
There's been a few non-bank lenders that have decreased some of their 5-year fixed rates. And because they're based off those 5-year bond yields, which we've seen have been down about 0.75% since June 14th, and does seem to be trending downwards. If that trend continues, we could see more lenders lowering their 5-year fixed rates. But I definitely think most banks are being quite conservative right now to see, will that trend actually continue downwards, or is it going to bounce back up again? They're holding tight for the time being, and we haven't seen any recent changes to the 5-year fixed rates. And this goes kind of along with the quantitative easing that happened over the pandemic, where the bank was pumping tons and tons of money into the bonds. And that was what brought those fixed rates down to historic lows. I remember one client we actually got like a 1.4 5-year fixed rate for, which was just insane. He just happened to
1.4 on a 5-year fixed. That is insane.
It was a high ratio mortgage, so less than 20% down, but he just happened to have the absolute perfect timing in the market. And yeah, it's basically free money at that point. And obviously that can't last forever. So it's starting in October, the Bank of Canada moved over to quantitative tightening, which is just about the opposite of what they were doing before. So now they're not putting money into the bonds. The bond prices have an inverse relationship with the bond yields. So the more money they put into the bonds, the bond prices go up and the yields go down. The quantitative tightening is just the opposite. They're putting less money into bonds, and now the yields we're going in the opposite direction. The yields were then going up quite substantially. So that's why we saw the fixed rates increase pretty dramatically as that quantitative tightening took place, basically starting last October. So we've just seen those steadily going up since. Whereas the variable rates, we had to wait until the Bank of Canada did their interest rate announcements this year to see those really catch up as well.
So to step this back a little bit for average consumers, what would a typical 5-year fixed rate have been over the last 2 years? So where are we coming from?
So we saw fixed rates that were around the 2% mark for a fair while, and now fixed rates for the similar kind of mortgage are in the high 4s to mid 5s typically. So a pretty dramatic increase on those.
So I mean, we're looking at roughly a 2.5%, very close to the actual Bank of Canada rate hikes. So we're looking at about a 2.5% increase, generally speaking.
Yeah, exactly.
So
a bit more for some lenders.
For an average, or maybe not for an average, but what kind of payment difference, or a better question, when you're applying for a mortgage, if you have, I know it's really hard to pick out details or give meaningful numbers because everybody's case is different. Everyone has a different income. Everyone has different expenses. The houses that they're buying are different. But generally speaking, how big of an impact does this have on the size of a mortgage someone gets? How is this impacting affordability?
Yeah, so that's definitely a great question. So when we're looking at affordability and borrowing power for the average consumer, it's based largely on the stress test. So the stress test is either 5.25% or 2% above the contract rate. By contract rate, I mean the rate that you actually get for your mortgage. So as soon as rates started to go over 3.25%, it was now harder to qualify because now your qualifying rate is higher than 5.25%. So
you say harder to qualify. I mean, people are still going to qualify. They're just going to qualify for less.
Yes, exactly. So someone who had $100,000 of household income last year would qualify for approximately $520,000 versus this year about $430,000. And that's with like an average kind of $400 per month car loan. So yeah, a pretty substantial decrease of almost $100K in borrowing power that's gone down since the kind of lowest period of the rates.
Wow. So would you expect this to bleed over into home prices? What would you say? You see far more mortgages than I do. What would you say the typical mortgage amount is for most borrowers? Let's say over the last 2 years versus what you've seen in the last 2 months.
Our mean mortgage size is around 400,000. So that's kind of your average, and it doesn't really. Obviously, there's extreme ends of the spectrum. There's $100,000 mortgages, and there's $2 million mortgages. Yeah. But for the most part, your average first-time home buyer and your average kind of downsizer have similar size of mortgages, because if you're selling a $2 million home and buying a $1 million home, okay, well, now you're putting 50% down. So lots of people that are moving down kind of have the same size of mortgages as first-time home buyers. So that's a pretty kind of average size for my business anyway, for most kind of people here in Kelowna. Obviously, lots of variety in there, but yeah, the true mean average is around 400,000.
All right. How many more rate hikes is the Bank of Canada expected to bring out this year? Or let's not say rate hikes specifically. How many announcements do they have scheduled for the remainder of the year?
So we're expecting at least 2 more rate hikes, and they have the opportunity to make emergency announcements and things like this outside of their regular posted schedule. So normally there's 4 times in a year that the Bank of Canada will make an announcement on the rate hikes, but they have, I believe, 8 actual meetings per year, so they actually can choose to make additional announcements and have more frequent rate increases or changes to prime, I should say. Historically, it's usually 2 to 3 times a year there's a change. So
Yep.
we're already kind of ahead of schedule in the number of changes to the prime rate, but there's definitely still more to come.
Right on. That's kind of all I've got right now. I don't think. Let me see if I've got comments coming in a different window or somewhere here. Again, this is a first time thing for anyone who's joining us. Actually, we do have a viewer online. Hi, viewer. If you have any questions, pop them in the comments. Comments should be live, and we can answer them on stream. So I got all distracted there. Is there anything? is there anything you'd like to say or add?
Yeah, definitely. With the rate increases, there are different ways that some people are affected. Most people don't really know the difference between a variable rate mortgage and adjustable rate mortgage. And the reason why is because everyone that has an adjustable rate mortgage advertises it as a variable rate.
So what is the difference between an adjustable?
Yeah, so the phrasing is a little confusing, but a true variable rate mortgage has a static payment. So your payment actually doesn't change. So if the interest rates go up, you start paying off less principal and more interest. Versus an adjustable rate mortgage, your payment fluctuates. So you're always paying off on the same schedule, but your payment will go up. So, someone who got a rate at the kind of bottom of last year for an average kind of $500K mortgage might see their payments go up by like $800 per month.
So with the adjustable, you still end up paying off the same amount of debt by the end of the term. So you have the same increase in equity.
Exactly. So you keep that amortization to be on the same schedule. Now, within a variable rate mortgage, what we are expecting after this next rate increase is now anyone that took a variable rate mortgage before any of these rate increases are now in a place where they might not be paying off any principal whatsoever. So what happens in those cases is referred to as the trigger rate. So the trigger rate is when the interest has increased enough that now the interest cost is higher than your total mortgage payment. And so what banks typically do is they look at, okay, well, what was the original balance of the mortgage? And what's the value of the home? And what's the current value of the remaining principal? So as you make your payments, continue to stay the same, but now you've got a negative amount on the principal pay down. So let's say there's $200 per month. That gets added back onto your principal. So your mortgage balance actually starts increasing.
So you actually end up paying more for your house. Well, I mean, of course you end up paying more for your house because the interest rates go up, but you actually end up owing more at the end of the term.
Well, potentially, but not necessarily more, because let's say you've spent the last year paying off, let's say $10,000 off your mortgage. Well, now you're going to be adding back onto that $10,000 that you've paid off. And if your value of your mortgage goes up to a percentage of the value of the home, the bank can then call you and say, hey, we're going to change your mortgage into a fixed rate. And if you put 20% down or more, this happens when your principal becomes 80% of your house value.
Good old 80-20.
So once you've gone back up to that 80%, so let's say you put 20% down, if you go back up to your original mortgage balance from this negative principal pay down on each month, then in that case, the bank will say, okay, sorry, we have to change this into a fixed rate. And you're just going to take the fixed rates that we have right now. And that's that. If you put, less than 20% down, if it's considered a high ratio or like an insured mortgage, in that case, they can typically go up to like 100 or 105% even, because it is insured. Wow. It's insured for the bank, but you do have a bit more wiggle room. But this does pose a bit of a challenge, because typically what would happen in other environments, let's say you had an adjustable rate mortgage for a longer period of time, well, you've paid off a lot of principal. But even if that principal does get back up to the 80% mark, you could go to the bank and say, hey, I want to do a valuation of my property. They'd say, okay, well, you can pay for an appraisal. And if the property value has gone up, okay, well, we'll give you a bit more room. You can keep making your payments. I'll keep adding to the principal. But in this kind of market, people don't really have that option if the price has gone down.
Now, when you say in this kind of market, what kind of market are you referring to?
Just the general, I guess, bear market, slight price correction. It doesn't take a large price correction for this to really have an effect, because if your property has not appreciated, you can't, extend that time that you can continue making the same payments. Because if you go get an appraisal and it says the house value is less than what you bought it for, even if it's $5,000-$10,000 less, that just means there's no room for you to continue riding out that same payment. And so typically when someone takes a true variable rate mortgage with a static payment, we do always advise, if there is a rate increase, call your bank and ask them to increase the payment manually. And so that way you continue paying off the principal at the same rate and you don't get affected by this trigger rate. Gotcha. But lots of people aren't aware of this because it's really just one little small line that comes with the package that they sign at the lawyer's office. This is what your trigger rate is, and there's not a whole lot of information there. So if clients aren't super aware of this component of a variable rate mortgage and they don't increase their payments, they could find themselves, suddenly having a much larger payment at the current fixed rates. Even though variable rates are pretty much, after the next rate increase, they'll probably be pretty much caught up to where the fixed rates are. It's still a big, sudden change in your payments where it's much more sustainable to, okay, well, after the first rate increase, you kicked your payments up by $100. After the next rate increase, you kicked your payments up by $200 or whatever it was. At that point, you wouldn't hit that trigger rate and you could just keep that variable rate mortgage. And the biggest benefit of keeping that variable rate mortgage is if we do start to see rates going down next year or the year after, well, then you can take advantage of that. Because if you lock into a fixed rate mortgage, well, if you want to break out of it, it's usually a much higher penalty that you have to pay, a prepayment penalty, we call them. Whereas with the variable rate mortgage, it's a smaller penalty. So if you want to change to a new lender, or if let's say fixed rates are just better in a year, so let's say fixed rates are much lower 2 years from now, you can move from a variable into a fixed, but you can't ever move back from a fixed into a variable. So it's a one-way street as far as how you can change that type of mortgage you have.
So we're actually running out of time, believe it or not, because we spent so much time just trying to get the stream working. So we got just over 5 minutes left. Really basic questions. When should a customer, or when should Joe Public Citizen decide to come and see you as opposed to maybe their bank?
It's always good to look at different options when you are working with the bank. And, lots of banks have really great branch reps, and lots of brokers are really great at the job. At the same time, lots of brokers are bad at the job, and lots of bank reps are bad at the job. So it's really about making sure that you have a good connection with someone that you can trust. And if you're working with a bank, obviously you're looking at one kind of product or one kind of group of products. So talking with a broker, we do get to show you a couple different options. Typically, when I'm working with a client, we'll have a budget review of which I'll pull up an Excel spreadsheet and say, okay, well, here's 3-4 different banks and lenders. Here's what their rates look like and their payments and all that kind of stuff. Here's how the mortgages are different from each other. And sometimes clients have banks that, my bank actually gave me a better offer. Here's what my bank's offer is. And, sometimes that's because of their personal relationship with their bank. Maybe they have a lot of investments there, or they've been with that bank for 20 years or things like that. And so it's always, my job to just kind of give you, an unbiased, transparent, here's kind of what the different options are. We can compare it with your options. We can, kind of help you understand how the mortgages are different from each other, because we do have to work with all these different banks and lenders that we have to learn what makes them different. Whereas a bank rep just at any individual branch, they're familiar with their products and their products alone. So, it doesn't hurt to, be working with your bank, especially if you have a good relationship with them. It also doesn't hurt to just be aware of what your other options are so that because, some banks may even let you qualify for more than other banks will. So you could walk into one bank and qualify for $500K and walk into another bank and qualify for $550. Everyone's guidelines are a little bit different, and their mortgage products are a little bit different too. So knowing your options is definitely half the battle.
So if nothing else, you're an excellent second opinion. And
yeah, definitely.
Actually, because you can work with multiple lenders, you're an excellent second, third, fourth, and fifth opinion.
Yeah, we never try to force anyone into one particular box. Yeah. My philosophy is really just to educate buyers as much as possible, to let them know what their options are, and that way they don't get kind of buyer's remorse or feel like they made the wrong decision, because they're educated, they know what they chose, and they're happy with the product that they chose.
Right on. Okay, so we're down to 3 minutes. I'm Byron Armstrong at Remax Kelowna. If you ever have any questions, you're looking for real estate, want to buy or sell, come get a hold of me. Byron in Kelowna on Facebook and Instagram. My phone number is 778-821-0232. And you are?
Graham Campbell. You can find me on Facebook at Campbell Mortgage Pros, my website, campbellmortgagepros.ca, and you can always give me a phone call at 250-826-9822 or shoot me an email at graham@campbellmortgagepros.ca.
Excellent. Thanks for joining me, Graham. Thanks for your patience. Facebook or wherever you're watching this video, thank you for your patience too, as we got everything set up and going here, and it'll be better next time. Thanks a lot. We'll see you in the next one. Now, technical question, how do I end the stream? There we go.